Hey guys, what's up? Stock Retail coming back to you. If you saw the last video Friday, we got the exciting earnings preview from Adam and the team. So that was a lot of fun to cover. And then what happened and what I'm going to cover today is I got a few questions on Twitter in particular. I think I saw a couple here on YouTube as well, kind of asking about some differences between, let's say, cash flow and earnings, which is very normal. But I realized, I got enough of the same question that I thought, why don't I just cover it real quickly? Some of you have heard me say a few times that sooner or later I'm going to do some educational videos on like how to read an income statement, how to read an entire earnings filing. In there is also the balance sheet and cash flows and all that. So I'm going to just touch on those topics today. We'll make this probably, I don't know, 15 minutes or something. Not a lot of news in this one. I'm just going to answer the question for people who'd like to understand a little more how to read some of these filings and what's the difference in some of the numbers. So that's what I'm going to cover today. So why don't I even just jump in? All right. So uh, first off, there's a few things I want to just help you know about that there's different parts of a filing. So I say here at the top, parts of a 10K, 10Q. So a 10K is the annual filing, a 10Q is the other 3 quarters. You get the quarterly filing. So once a year, you get that annual filing. Then the other 3 times a year, you get this 10Q, the quarterly filing. And you can track quarter to quarter, year over year, kind of how are things going for a business. I think that's really important. I've mentioned that at some point I may branch out and do kind of like other like earnings previews and investment thoughts and thesis. That's kind of how I get to those a lot of times. Like I'll look through a company's filings and understand the health of their business and whether I feel good about them or not. That's another conversation for another day, but so that you know, here's some parts of what you would see in these filings. So you'll see an income statement. Sometimes on my channel, you've heard me call that a P&L. That's just kind of in the language of business. You talk about profit and loss. Even business managers, you'll have something called a P&L owner, like people who make the decisions on spending money and owning whether a certain business unit is making money or not. So income statement, or if you hear me ever call that P&L, that's what you're going to see there. That's mostly what people kind of talk about when I see different posts on Twitter or YouTube is the income statement, which ultimately kind of gets you to the earnings. When people talk about earnings, the earnings release, something called net income, you're mostly looking at the bottom, and we even call it the bottom line, right? The bottom of an income statement. Like when you talk about earnings per share too, and some things like that. So there are some other important documents though when we talk about, like, let's say debt, for example, or we talk about how much cash AMC has. There's a thing called the balance sheet that's going to give you basically assets versus liabilities. So if the income statement is profit and loss, balance sheet is assets and liabilities. And then you've also got another document in there that's called the statement of cash flows. And by the way, just go to SEC's Edgar site or go to AMC's investor relations site. Go find some of these filings, these 10Ks, these 10Qs, and just as an exercise, try to go find these things and start to get familiar with them. Like I said, I'll do a deep dive video sometime, literally line by line on how to read these. And get more strategic too, so it's not boring. Like, here's how you can interpret things from these. I'm not going to do that today, so that's why I'm just encouraging you. Maybe go take a look if you haven't before, and you can get straight to the source for any company, really. Go find their filings, and you'll find an income statement, a balance sheet, and a statement of cash flows. Think of those as, in a way, as 3 different documents that are all going to be in the earnings filing. And this is probably where it gets confusing because we'll say, hey, there was an earnings release or there's an earnings call, and we kind of wrap all of this into earnings. But then there's actually a number that is earnings. So we mean 2 different things with the same word, and that's why it gets confusing. Earnings can mean the entire documentation of everything that happened in the quarter, which has this income statement, balance sheet, and statement of cash flows. Or earnings can also mean just what's that net income number at the bottom line. You'll also find in filings kind of what I'm calling supplemental or non-GAAP information, so that you know GAAP is generally accepted accounting principles. It's an American, it's basically the way that we regulate accounting for the business. In Europe, you have something else. It's not GAAP, but it's very similar. A few rules are a little bit different in Europe, but most are pretty similar. So just in any country where there are publicly traded companies, you've got rules for how you need to account for your business so that we have standardization. But so the thing is, if GAAP is standard, you would know then when you see non-GAAP information, like when Adam talks about EBITDA, or there's a number AMC will provide that's cash burn or contribution from operations. And so there's different things that they'll provide. It's just the business leaders of a company saying, hey, we think that our investors would like a little more information. So we're providing outside of these standard income statement, balance sheet, and statement of cash flows that are very rigid and have to be a certain way. We're going to give you some of this other non-rigid information that isn't always guided by GAAP. And so that's just good to know too. So you're going to see all of that in a 10K 10Q. And that matters because there is a difference between earnings and cash flows. So I'm going to start to kind of explain some of that. And I'm showing you just a little snippet of my spreadsheet I use every quarter. I capture, I've told you I have like, I don't know now, 20 plus quarters. I go all the way back to 2018. I've got every single line from every single filing that they've got. Here I'm showing you their expenses. So these are AMC's expenses. You could find these exact lines in one of their income statements. You're just seeing these in my sort of spreadsheet view, but these are exactly from the income statement. So you can see here was Q4. So you could go find all these numbers. These came from their filing. And I'm just showing you the expenses. And the reason is I want you to know that there are non-cash expenses. So notice I've got a list here of a few non-cash items. So depreciation and amortization. So you could go down here and you'd say, all right, they had $86 million in Q4, this 85.9 of depreciation and amortization. Well, that shows up as an expense. It decreases your earnings, but it was not a cash expense. It's just on paper. And you get impairment. So mostly in the fourth quarter, I've noticed we tend to have this goodwill impairment. That's been an item of quite a bit of FUD over the years for you guys. And I've tried very hard. I made a whole video just on impairment because we were getting FUDed so hard by a Costco janitor. Some of you know who I'm talking about, who had no business talking about GAAP accounting. But anyway, impairment is a non-cash expense. I'm not going to go explain all that right now. Like I said, I've got a whole video on that, and I don't want to go too deep today. You can see that AMC specifically has this, it's even literally called non-cash NCM Exhibitor Services Agreement. So you guys know the NCMI, that stock, like when you go early and you see the advertisements and stuff like that. So we've got this deal where we basically book expenses, and then later there's ways that we even book other revenue. AMC kind of explains it in some verbiage. You can also find a lot of like write-up, and it's a lot to read. So it's like the whole TLDR thing. You can read a lot in these filings, and there's parts where AMC will explain how they account for the kind of expenses and then the income from these advertisements. But it does show up basically quarter in, quarter out. It's always this kind of between $9 and $10 million number, mostly like 9.5. But that is a non-cash expense. No cash goes out the door, even though it takes a bite out of earnings. And I'm going to tell you in a minute why that's actually a good thing. And then we've got investment expense or income. When this is a negative number, it means we actually made money. So that's decreasing expenses. That's why it's a negative expense, or you could think of it as an income. I've told you before, like when Highcroft, if the stock goes up in a quarter, you're going to see a number here that's nice. Like we're going to see basically adding to income by having a negative expense here that's going to be kind of booked here. So there's all these non-cash things that happen. Like if Highcroft stock moves and AMC doesn't sell or buy the stock, there's no cash coming in or going out the door. And yet it shows up in earnings. All of these lines are you take your revenue. By the way, this number at the top is just the box office. That's just from my spreadsheet. I track the box office there too. But you take your revenue and then you subtract out expenses and you get to earnings, right? Well, if some of these expenses are non-cash, they're just on paper, your earnings number is not a cash number. It's not the same as cash that came in or went out. And you might say, well, why do we count all these expenses that aren't really, if it's not an expense, like I'm not actually paying any money out the door? Well, it's for taxes. So that's the bottom here I'm telling you. Earnings are what you use for taxes. So you can even see here, this last quarter, AMC had a negative income tax. Basically means we got to kind of book future savings in a way. Like when we start to have to pay taxes, since we had a loss, there's no income, so you don't pay taxes on that. But the thing is, say when I've told you we're coming into profits here soon, right? Like I've said, I think Q3 and beyond, certainly 2025 and 2026. But I've even said Q3 and Q4, I think we may be profitable. That's on this earnings report. So there would be a bunch of lines up here you don't see that I have for revenue. And then you've got all these lines for expense, and you get to like a bottom line. Well, the reason Adam tells you an EBITDA number, it's earnings before interest, taxes, depreciation, and amortization. And so you figure out your earnings, and then from that, you pay taxes. And so wouldn't it be nice if you could have a lower earnings number and pay less taxes and keep more of that cash in your side of the business? And the reason for that is it's in theory, it's US tax code that's encouraging investment. So depreciation and amortization, for example, if AMC went and like did some new construction and had like long lasting investments, it's called capital expenses. They can depreciate those over time. They can basically say, we spent all this money to invest in our business. We're going to claim it as this like long-standing expense in a bunch of earnings and depreciate this investment, and it reduces taxes. So in theory, the tax code is built to sort of encourage investment. Um, I'm just saying in theory because you can get into all kinds of economic debates, but I'm letting you know that the tax code allows companies to take money out of their earnings so that they pay less taxes. That's what's happening. And so you just want to know that earnings is not cash flows, right? So that's the first thing to know. All right, so there is a statement of cash flows. I'm showing you a screenshot. This is by no means the whole thing. If you were to go to one of the filings, you'll see there's a bunch of lines I'm not even showing you. And it's because it would have gotten too small for you to even read. So there's a whole bunch of other lines. This is not all the cash flows. And you can even see, you go find consolidated statements of cash flows. You're going to want to be careful with that because like in the first quarter, it's going to be just a pretty easy to read, straightforward item. But then they track it through the year. And so you want to actually get to figuring out the change each quarter. Quarter over quarter. So like so Q2 would show like a 6-month version. Well, that's 2 quarters combined. It's kind of showing you the cash flows through the year. Anyway, so you can see there are things like I just told you, depreciation and amortization is not a cash expense. So you can see that was getting added back in here to get to what was our actual cash flow. You can see deferred income taxes. So this is basically it's a statement telling you what actual cash was going in and out the door. And so you're correcting for all these things I just told you that were non-cash. And then you're also having to think about the timing of payments. On the balance sheet, you're going to have something called accounts pay. Actually, here, let's actually just go forward. So some other things on the balance sheet, you're going to have this accounts payable and accounts receivable. Well, I've told you about that in some earnings reviews I do, where it's like accounts payable think of it like a credit account. And say AMC buys a whole bunch of the popcorn buckets to sell. And if you get, say, 30 days to pay whoever manufactured the popcorn buckets, right? Like there's a factory who made those. Let's say you take them in and you have 30 days to pay them or something. I'm making that up. There's different payment terms. A lot of times there's something called a net 30. Well, if you have these 30 days to pay, you owe somebody money. And so for accounting purposes, so here's that back to like a GAAP, accounting purposes, accounting principles. For accounting, you need to keep track of the fact that you owe somebody money. That's accounts payable. But if I haven't paid them yet, then it hasn't impacted my cash. So that matters for your cash flows. I haven't sent the cash out the door. And so now you start to see how all these different documents start to come together. Accounts receivable is somebody owes me money and they haven't paid me yet. But I know I'm going to be getting that soon. So these are kind of in your assets and liabilities, these accounts payable and these accounts receivable. Accounts receivable is an asset because you're getting to count that, hey, pretty soon here I'm going to have that money. Accounts payable is a liability. Pretty soon here I'm going to have that bill. But that impacts cash flows. And I've told you that in a few earnings reviews where if you can manage accounts payable and accounts receivable, you can also kind of improve your cash flows because there's something else called free cash flow that I've told you guys is something really good to watch. You want to watch AMC turning into positive free cash flow, which we had. Remember last year, Q3 was so phenomenal. We had Barbenheimer and all that stuff, and so we had positive free cash flow, which was fantastic. Corporate borrowings, that's another item you're going to see, and I don't remember, I don't think I see it here. I think it's farther down, but you would see it in the cash flow statement as well. Let's say there is a quarter where we pay down debt. So you're going to see cash went out to go, it'll be called like extinguishment of debt. You put out that debt. But there's other quarters we've had in the past where we brought in more debt to add to our cash. So, the flip side of debt, and I've talked to you guys about this in terms of value creation, like with dilution too. The flip side of dilution is you're bringing in cash. So you would also see that in the cash cash flow statement, where if we sell stock, which we just did, um, that is adding to your cash position. So there's other things you're going to see where you're either bringing in or paying out cash that are not really part of earnings. You didn't have income or expense there. That it's kind of separate from that. All right, and then investments. I mentioned to you capital expenditures. So you've got operating expenses. People in business call that OPEX, not to be confused with like options expiry. That always messes me up because I'm from a world where OPEX meant operating expenses. Um, and then you've got CapEx. So capital expenditures, that's like I said, the longer term investment that you're allowed to depreciate over time. Um, and in general, and when I come around to teaching you guys how to read this stuff, and by the way, I don't mean that condescending at all. Some of you who are listening may even know better than I how to read these documents. I'm just saying for the people who aren't used to this stuff, I like to make it, let's call it user friendly, speak in plain English. So sometime I'll deep dive on that stuff. And one of the things I look for is a company healthy enough that they can strategically invest. And so you will see, you can go find this in AMC's filings. They're showing you where they are investing for growth. They have a line for it. They break out their capital expenses. Where are they doing construction? Where are they investing in growth? You can see what they're investing in. And so, for example, if they need to refurbish a theater because it needs new seats, or remember, we're getting the laser projectors in some theaters, those take investment. Those are capital expenditures. And you get into some real detailed rules on what you're allowed to count as a capital expense versus what you cannot. And so it's not all of their expenses that go here. That's why I also mentioned operating expenses. Paying the electric bill is an operating expense. Building a new building is a capital expense. And so you track those separately. It can mean a sign of a healthy business, though. It's telling you they have enough money to invest in themselves for future earnings. And so that's somewhere you track also. But that impacts your cash flows. All right, so almost done here, guys. I'm just reminding you that I've been showing you this every quarter, so you can see some things. I show you what our operating expenses are as a percent of revenue. I'm showing you our assets, remember, so like our cash, our current liquidity. I'm showing you our free cash flow. I'm talking about accounts payable and receivable. I'm talking about assets versus liabilities. You've got other things here that are, here's actual earnings. I'm giving you parts of the income in terms of admissions and food and beverage. I have had this balance scorecard since 2021, maybe even. I'll have to go back and see how many of these I published. I think the first one was like on Reddit. The reason I track across these, so now you're seeing I'm tracking our cash, I'm tracking our balance sheet, and I'm tracking our income statement. All of these matter. And so that's why I show you this every quarter and I'm saying, hey, are we moving in the right direction? You can see this was from Q3. I'm just going to openly admit I cherry picked that because it was a great quarter. And that was where I said we had that positive free cash flow. Really good. I mean, geez, that was a great, great number. We had improved by almost 300 million versus the year before. Uh, this actually is kind of a wrong title at the top. But anyway, and we had positive free cash flow of $8 million. So you can see that's not matching the earnings. Like our net income was 12 million, but our positive free cash flow was 8 million. So you see how they're not matching. And that's all the things I just told you about. So kind of in summary, cash and earnings are not the same. I'll post this on Twitter because that's where I also saw a few of those questions. Just want to keep in mind that in your earnings, you've got a lot of non-cash events. And then on top of that, you've got timing issues with that accounts payable and accounts receivable. And all of it is just a way to track the overall health of the business. You want to track all of it in a balanced view, which is what I'm trying to do for you guys quarter in and quarter out. I think the bottom line, because, most of you are here for AMC, not just for learning how to read this stuff. We are moving more and more healthy. You'll hear Adam talk about a healthy balance sheet. You'll hear Adam talk about profitability. These are two different parts of setting us on the right foot. The healthy balance sheet is kind of getting us into a place where, let's say, kind of classic money and old money look at you and go, okay, that's a really healthy company. I like the structure of that company. The profitability is sort of our survive then thrive, right? We're going to be moving that direction, and I see a lot of good things coming. So as you know, I feel great about this company. I love the stock, and we will win.